Let's talk about bonds, shall we? Now, before you roll your eyes and think, oh no, not another boring finance topic, let me assure you that bonds can be quite interesting when you break them down into bite-sized pieces. Think of bonds as a friendly loan agreement, where you, the investor, are the lender. Instead of lending money to a friend who promises to pay you back next week, you're lending money to the government or a corporation, and they're promising to pay you back over a longer period, typically with a little extra, interest that is. So, what exactly is a bond? At its core, a bond is a fixed income instrument that represents a loan made by an investor to a borrower, usually a corporation or government. When you buy a bond, you're essentially buying a piece of that loan. The borrower issues bonds to raise money, and in return, they agree to pay you back the principal amount on a specified maturity date, along with periodic interest payments, known as coupon payments. It's like a promise note, but with a bit more structure. Now, let's dive into some key terms to help you navigate this world of bonds. First up, we have the face value, also known as par value. This is the amount the bond will be worth at maturity, and the amount the issuer agrees to pay back. Most bonds have a face value of $1,000, but they can vary. Next, we have the coupon rate, which is the interest rate that the bond issuer will pay you. If you have a bond with a 5% coupon rate, and you hold a bond with a $1,000 face value, you'll receive $50 a year until it matures. Easy, right? Now, let's talk about maturity. This is when the bond will fully pay back its face value. Bonds can have a short, medium, or long-term maturity. Short-term bonds usually mature in 1 to 3 years, medium-term bonds in 4 to 10 years, and long-term bonds can take 10 years or more. Generally, the longer the maturity, the higher the risk, but also the potential for greater returns. It's a balancing act. You might be wondering, why would anyone want to invest in bonds? Well, bonds can be an excellent addition to your investment portfolio for several reasons. First, they're generally considered safer than stocks. While stocks can fluctuate wildly in value, bonds tend to provide more stable returns. This makes them an attractive option for those who are risk-averse or looking for steady income, especially retirees or those nearing retirement. But don't let that safety fool you. Bonds can still be impacted by market conditions. Interest rates, for instance, play a significant role in bond prices. When interest rates rise, existing bonds with lower rates become less attractive, causing their prices to drop. Conversely, when interest rates fall, existing bonds with higher rates become more desirable, driving their prices up. This is a crucial concept to understand because it can affect your investment's value before maturity. Now, there are different types of bonds to consider. Government bonds, like U.S. Treasury bonds, are backed by the government and are considered among the safest investments. Then we have municipal bonds, issued by states or local governments, often providing tax-free interest income. Corporate bonds, on the other hand, are issued by companies and carry a higher risk since they depend on the company's financial health. If a company goes bankrupt, bondholders may not get their money back. Another type worth mentioning is high-yield bonds, often called junk bonds. These are issued by companies with lower credit ratings. They offer higher interest rates to compensate for the increased risk. Investing in these can be like playing with fire. You can get burned, but if you're careful, you might just find a gem. Now, let's address the elephant in the room. How do you actually buy bonds? You can purchase them directly from the government through Treasury Direct for government bonds, or you can buy them through a broker or an online trading platform. Many mutual funds and exchange-traded funds, ETFs, also invest in bonds, providing you with diversified exposure without needing to pick individual bonds. This can be a great way to ease into the bond market if you're feeling a bit overwhelmed. One common misconception is that bonds are boring. Sure, they may not have the thrill of a stock shooting up overnight, but they can offer a reliable income stream and help balance out the volatility of stocks in your portfolio. Think of them as the steady, dependable friend who keeps you grounded when things get a little too wild. Now, let's talk about the importance of diversification. Just like you wouldn't put all your eggs in one basket when investing in stocks, the same principle applies to bonds. Spreading your investments across various types of bonds can help mitigate risks. If one sector takes a hit, others may hold steady or even thrive, providing a cushion for your overall portfolio. And here's a fun fact. Bonds can also be a great way to teach younger generations about investing. If you have kids or grandkids, consider introducing them to bonds. It's a tangible way to show them the value of saving and earning interest over time. Plus, it can spark conversations about money management, which is a skill everyone should learn. In conclusion, bonds are not just a dull financial instrument. They're a versatile tool that can enhance your investment strategy. They provide stability, income, and a way to diversify your portfolio. So the next time you hear the word bond, don't think of it as a complex financial term reserved for Wall Street experts. Instead, think of it as a friendly way to lend your money and earn some interest while you're at it. With a little understanding and a dash of curiosity, you'll find that bonds can be an approachable and valuable part of your investment journey. Happy investing!